So we're going to go through a few things today. We're going to do some good news, because one thing there's not enough of in the world is good news. So every time you see me speak, I'm going to start with a couple pieces of good news you probably didn't know about.
Down is next.
Down is next. Okay, not up is next. User error. There we go. So, and then we're going to give a market update, and that's largely because people, when we stand up to speak, they want to hear market updates. So we're going to go through, and it's exciting times right now, and Josh has got some exciting things to say. And then we're going to go through things you can do when it comes to investing, but you probably shouldn't. So we're going to step through some popular things, some popular ideas, things people are talking about. Our goal is to educate you so that when somebody comes up to you and talks about a really good idea, you have a bit more information to put that in context and understand what's really going on. There's a lot of things that are being said. A lot of people are losing a lot of money. We want to make sure that we try to educate people as much as we can to protect them from some of the dangers that are out there. So, well, down is up. Got it. Good news. They have cured type 1 diabetes in rats. They actually have a treatment that has been successful in completely erasing type 1 diabetes. Sorry, mice, not rats. That's a mouse. Now again, that doesn't mean we're ready to cure it in people, but a nerd somewhere in a lab has been successful. And has anybody heard about this? Isn't this big enough news that it probably should have made the news somewhere that we've cured type 1 diabetes? There you go. You're welcome. Stem cell injections of some description. I'm not that much of a geek. I just read the article. I know that lots of people are in. So that's a big deal, and that's the kind of stuff we don't hear enough about. The next one is that they have reintroduced, now I don't know if it's tortoise or tortoises, I call them tortoise, in the Galapagos Islands. It's been 180 years since this particular species existed in the Galapagos, and they have successfully reintroduced them. Now, last time I gave this presentation, somebody had just come back from the Galapagos Islands who had seen them, so this is real. Has anybody here just come back from the Galapagos Islands? Okay, that's a future check I'm going to keep an eye on. Big deal. Galapagos Islands are a very biodiverse environment, and they're having success in reintroducing some things that were the staples of the Galapagos. And again, I still need to look up whether it's tortoises or tortoise, but anyway, a bunch of them. So with that, I'm going to pass it off to Josh, and Josh, the down arrow means up, so just don't make the same mistake I did.
So markets, I've already had a couple people say today, I don't think they use the term exciting like Colin used, but scary, a little bit volatile, that's definitely happening right now. But I'm going to go over a couple things with you. The first is the headlines versus the fundamentals, and I'm going to go to my piece of paper here so I can actually read some of these headlines that I pulled out today. So there tends to be, with the world, with the media, a bit of a dislocation between what the media is saying, what the headlines are telling you, and what is actually happening in the world. So I'm going to read you a couple headlines, and then I will give you the actual facts. Headline number one, this is from today. Bonds, stocks decline as Iran sustains attacks. So that's the headline for today. Stocks and bonds are down. But if you look at over the past 6 months, stocks are about flat. If you look at over the past 12 months, stocks are up by double-digit percentages. And if you look at bonds, they're actually up since the start of the year. So yeah, today, this month, things might be a little bit volatile. They might be down. But over any reasonable long-term, medium-term time horizon, things are doing pretty good. Headline number two, Iran war escalation wakes markets up to risks of deeper economic pain. So I think everybody's heard about this, everybody's talking about it. Yes, there are some risks from the Iran war that might challenge economies a little bit. Well, here's the facts. Over the last 6 months, on average, both Canada and the US have added jobs to their job market. Unemployment rates are down to stable in both countries over that period of time. Inflation rates to the end of February were as low as they've been probably in 3 or 4 years. So risks, yeah, sure, but everything pretty much up to the start of March was running fairly positively. So here's another thing where the headlines are a little bit dislocated from the reality. So tariffs, we know tariffs are scary. Tariffs were scary when Trump introduced them last year. there's a little bit of funny stuff going on. So you might not be able to see the numbers here, but in 2025, China reported exporting $420 billion worth of goods to the US. In 2025, the US reported importing $308 billion of goods from China. So there's a $112 billion gap between what these two countries are reporting. I'd like you to tell me, what do you think's happening to that $112 billion worth of goods between leaving China and entering the US? Anybody have any guesses?
Somebody's lying.
That's a good guess, Larry. Somebody's lying. So as the saying goes, follow the money, right, to see what's happening. So there's a couple things that could be happening. I don't know what's happening. I don't know exactly what's happening. There's a couple things that could be happening. One, businesses, shipping companies are finding creative ways to change or alter the origin of the goods that they're shipping. I would say that there's a very good likelihood that that's happening to some extent. Second thing that could be happening is perhaps shippers are not necessarily changing the origin of the goods, but maybe they're rerouting the goods. And I heard this early on when tariffs were introduced, that a few things were going to happen. Either companies were going to go out of business. That's probably happened a little bit, but probably not. I haven't seen it to a significant extent. Companies are going to find creative ways to throw perhaps a Thai or a Vietnamese flag on something that's coming from China, or companies will actually reroute through a different country, so the origin of the goods is different. So this is one of those things where the tariffs, the headlines were very scary at the time. And as is so often the case in the world, companies, businesses, countries are creative. They're dynamic. They'll figure out ways around the hurdles that you throw them. So obviously the elephant in the room right now is the war that's going on. If we call it that. We had a debate last week on our investment call. What do we call this? Do we call it a skirmish? Do we call it a conflict? Do we call it a war? Somebody threw out the word Donnybrook, so we might be calling it that. If you look historically, the returns on stocks following geopolitical events, or in this case, what I'm representing here, the US involvement in some type of military conflict, actually not so bad. There's volatility around that event, for sure, early on. But if you look at even over a 6-month time horizon, results have been pretty good for stocks. 12 months, even better. 3 years after that, pretty good still, right? So this is not to say that there's nothing to worry about here. This is not to say that there's not all kinds of issues being created by the war on a humanitarian level. And it's not to say that this is good for economies. I don't want to make that argument. But it is to say that historically, if you look back even since World War II, you can look at dozens of different geopolitical events, dozens of different actually armed conflicts. Markets tend to do okay, at least okay, and in some cases very good. Now these are just averages. So there's a saying that I use sometimes: if your head's in the freezer and your feet are in the oven, on average you're the perfect temperature. But even if you look at individual events, it's very hard to find any individual events historically, aside from maybe one or two, where there's a direct link between armed conflict and bad for markets. This is going to be really small way at the back. I'll explain it to you. So the big challenge that's getting talked about right now is the price of oil, and somebody already today was mentioning how high the price of gas is. They saw it at $1.70 a liter. So yes, gasoline is very expensive. A big part of that is the price of oil. So there's a lot of concern about what the price of oil is going to do for economies. This bar chart that you probably can't see represents several different events where the price of oil spiked more than 20% over a 2-day period. So that's a lot, 20% up over 2 days. And what you see or may not see from the chart is that historically, stock markets have done pretty good 12 months following that type of event. There's one situation in 2008 where that wasn't the case. Oil spiked and stock markets were down the following 12 months. But that was 2008. I think there were a few other different things going on at that time that was not specific to the oil causing that issue, right? So again, I don't want to represent that the price of oil being up is a good thing. It's not. It's going to be challenging for economies. You're all, including me, we're going to have less money in our pockets to spend on fun things because we'll be spending money on gas. That's not a good thing for the economies at large. But it does represent that high oil prices are not a death blow for the economy, and that historically we've done pretty well in these types of scenarios. There's probably far more important things going on in affecting economies than the price of oil specifically. Again, a bit of a busy chart here, but I don't think I could get through this without talking about AI at least a little bit. We haven't seen the same impact on the stock market from AI this year that we had last year. What we started to see this year from AI is concern over which industries or sectors are going to be most affected by AI. And throughout the month of February, it was like every day you open up your news feed and it's like software stocks get punished because of fears of AI. Cybersecurity stocks get punished because of fears over AI. Insurance brokers, logistics companies, trucking companies, real estate companies, investment companies punished because of AI. It's like every day the market woke up and felt that something else was at risk from AI, so all of a sudden it gets punished. February 2nd is a great example, the far left part of this slide here. On that day, software stocks, which have probably been the most punished from AI, were down 5%, but the market at large was up. And that's what you're seeing in a lot of headlines. And coming back to what I talked about before, there's often a mismatch between what's happening in reality and what the headlines are telling you. We had a call with a company that we invest with called Hamilton Lane earlier this week. They are a private equity and venture capital company. So they're basically taking money and investing it in cutting-edge businesses, new businesses, some of the most innovative businesses on the planet. This company is seeing them firsthand and investing in them. And we asked them, we said, what are you seeing these companies do with AI? Because these are some of the most innovative companies on the planet. What are you seeing them do with it? And the representative there said to us, we're not seeing any companies really drive revenue from AI use yet, and we're not seeing any companies really cut costs from the use of AI yet. Everybody's experimenting with it. Nobody's doing anything very material to their bottom line. So he said, I don't really know what's going to happen with AI. And this is, again, this is somebody that's probably one of the most plugged in people in the country on what's at the forefront of the AI and technology push. And he doesn't know what's going to happen. Their business doesn't know what's going to happen. So we don't know what's going to happen collectively, and we're not going to try to guess. There's going to be winners and losers for sure. We don't know exactly who they're going to be yet. Time will tell. So this is a chart that shows the US and Canadian stock market plotted against each other over the last 10 years. The simple way to look at this is where the blue line is below that dark horizontal line, Canada sucks. Where that blue line spikes above the black horizontal line, Canada good. So throughout a lot of the last few years, we started to get questions, why don't you just own the S&P 500? The S&P 500 is a representation of US stocks. Why would you invest anywhere outside of the US? And the reason is, for most of the last 15 years, the US has been better than Canada. Now all of a sudden that's switched, and we're starting to get the opposite type of questions. Why isn't my portfolio doing as well as the Canadian stock market? Canadian stock market, yeah, once in a while it has its time in the sun, and it does really well. The reality is we're not trying to beat the US market for you. We're not trying to beat the Canadian market for you. What we're trying to do is get the most reliable, predictable, surefire way to get you to your goals. So for us, that means that most of the time we're going to have, I shouldn't say most of the time, all of the time, we're going to have some Canadian stocks, we're going to have some US stocks. So we're going to benefit, we're going to do okay when the US market's outperforming the Canadian market. We're going to do fine when the Canadian market is outperforming the US. We're never going to be the best. We're not trying to align your portfolio with the best things at all times. But it's interesting how that narrative changes. What's doing well recently, all of a sudden we start getting questions about that one specific thing. all of these things that I've talked about, they all relate to volatility of the stock market in some way, shape, or form. And the thing about volatility is it's a feature of the market. It's not a bug or a flaw, it's just an inherent feature of the market. It's something that we have to live with as investors in stocks. Part of the reason why stocks have generated a 9% per year return on average over the last 100 years is because that's the return that you get, the compensation that you get for living with the uncomfortable volatility that comes along with it. There's this concept in Japan, it's an art form in Japan called kintsugi. And what it is when things break, they put it together in their view a more beautiful way using gold, or it's like a gold solution, essentially. There's a picture of what it could look like here. And that's kind of how markets work too. Things will break from time to time. Things will go down from time to time. But if you've built your portfolio properly, which we think we have, we're going to take those pieces and we're going to be able to construct them, reconstruct them in a better way so we get something that's more effective over the long run. And in effect, things are going to recover to a higher point. They're going to be better at some point because the things that fall off when you have, say, a market correction or a downturn is the most fragile parts, the weakest parts of the overall market. And that's also important for the long-term success and growth of the world and the economy and the market as well. So before I pass it off to Colin, does anyone have questions about markets, economies, the war, what we're seeing out there? Happy to go anywhere you want.
It won't be the last time we ask. So think of your questions, suck up your courage. You can ask later, or you can interrupt me at any time. So I'm going to take you through 5 different themes of investing that have been popular, that people have said are really good things, and maybe give you information that'll help you put it in its place. I'll start by saying very little is inherently a bad idea, although there is one bad idea we will talk about. Very little is inherently evil. But putting things in proper perspective is very, very important, and understanding what things are is very, very important. Now, gold is an investment. I wish I had the same PR firm that gold has, because everybody believes so deeply in gold as an investment, and it's really, really tough to find the evidence. But the belief is still out there. So let's walk through some numbers so you understand the role that gold has played in people's performance and where some of the perception comes from and where it's disappointed. There was a 20-year period between 1980 and 2000 where if you had invested your money in gold, your annual rate of return would have been about 2%, a 20-year period. Okay. During that same period, the S&P 500 was up 17% per year. That's a 20-year time frame. But sometimes gold is good. A 10-year period from 2000 to 2011, gold was up 17%, and the S&P was only up 2% over that same 10-year period. What happened between 2000 and 2011 that had nothing to do with gold that would have affected those numbers in a big way? This room's old enough. We should remember these things. What happened in 2000? Dot-com bubble. Y2K.com bubble. Pets.com at a valuation of a few $1 billion, never actually did anything. There was a huge wreck in the stock market around 2000 as the tech bubble exploded. Then in 2008, we had the financial collapse, the 2 largest disruptions that the financial markets have seen. So in a period of 10 years where you had these 2 major events that had nothing to do with gold, gold actually held up pretty well. So there you go. 20 years where it sucked, 10 years where it was really, really good. Most recently, 2021 to 2026, gold is, well, it's not as good now. We haven't updated these numbers because these numbers would not look as flattering right now. Gold's 24% compared to 14% in the S&P 500. Now, to Josh's point earlier, when we're looking to invest your money, it's not about getting the best return. It's about getting a consistent return. So if we happen to have been wrong in the last 5 years and allocated money to the equity markets at 14%, you're doing okay. But you did miss out because gold in this last spike that has gone through has looked really attractive and gotten a lot more attention. Oh, down button means up, got it. If you stretch it out and go from 1996 to 2026, gold's average is 7.4 and the S&P is almost 11. If you can't tell, if there's no reliable way to move in and out of an asset, then it's very, very difficult to make those trades properly. And then you take a look at the longer-term averages to guide. So you could have done better over the long term in holding an equity investment than you could have done by holding gold bullion. Is gold a safe haven? Now this is the one that drives me nuts because I'm a curious person and I watch things. So every time the world seems like it's blowing up, I'm going to go look at gold and say, how's it doing? Because if the PR people are right, it's a safe haven. It protects value. That's why it's there. Well, 2008 financial crisis, when that was as close as we come to the fiat currency, as they say, being no longer accepted. Like that was as close as we came to a monetary system problem. Okay, now is gold's time. No, it was a 30% decline between March and October. So from a technical perspective, when I would expect that gold would have done its best, this is the perfect storm that gold's going to do well, it let everybody down. 2020 COVID had a 12% drop in 1 week. Again, everybody was scared. Well, they tell me when people are scared, they're going to go buy gold. It didn't hold up then either. And then we had the Ayatollah drop that they called it. I'm not sure why we call it the Ayatollah drop, but there's 9% drop in 1 day in January of this year. And it's fallen off a cliff. Is it safe to say it's off a cliff? It's down again the last few days.
It climbed the cliff and then jumped off.
It climbed up the cliff and then jumped off.
Yeah, and I think it's down for 7 to maybe today, 8 straight days now. At a point where, again, you would hope that there would be some safe haven appeal to it.
You would expect. So the people that are standing up saying gold protects you during troubled times seem troubled. I'm not feeling protected. It's not holding up for that reason. And then there's the practical challenges, and I'm going to do a thorough takedown of gold because gold bugs are really, really determined, so I'm going to take it apart on a whole bunch of levels. You want to buy gold. Okay, how are you going to do that? Are you going to buy the actual bullion? The spot price that you see is the bullion price. So you can go to Costco, and they will sell you a bar of gold, and you're going to pay a premium to buy it, and then when you sell it, you're going to sell it at a discount, and you got to have somewhere to store it and keep it safe, and you can't use it to buy anything with. Oh, okay, well, I'm just going to buy shares in a gold mining company, or I'm going to buy another form of it. The liquidity and insurance costs of maintaining a gold stash eats away at the potential rate of return you could see. If you get into an ETF that says it's a gold ETF, you're buying a derivative of gold. You're not buying the actual spot price. There's lots of things that erode the value of that investment as well. So you're not actually buying the bullion. You're buying a piece of paper that's promising to be something like the bullion. And there's costs in that. There's transactional costs, and it eats away at the rates of return. Because the rates of return that we used here are the spot price, which is not really attainable. Mining companies and gold prices. I'm on record as saying that the mining companies in Canada have destroyed more capital than the rest of the industries put together. Because everybody gets excited. We're going to go drill for gold. We're going to find gold. Oh my God, you're going to find gold. I'm going to invest with you. I'm going to get a tax break. And when you hit gold, I'm going to get rich. That story is very sellable. If I stood up here and promoted a gold mining opportunity, I could fill this room and raise capital like that. Because it's so easy to raise capital for that purpose, it attracts a lot of people who are not successful at it. So if you take a look through history, gold, there's notable times when it hasn't held up as expected, as a safe place to have your money. It hasn't outperformed alternatives over time. And it's had protracted periods of time when it severely lags. If you are invested in an asset class that's underwater for 20 years, that's the length of a pretty good retirement. So that's an impact for a retail investor to be careful of. Now, I recognize anybody who came into this room a gold bug is sitting there disagreeing with me, and I haven't turned you around at all. But for those who are in a conversation with a gold bug, this information should help you understand a little bit what the downside to investing in gold is like. What I will say is that our portfolios that we have are invested in the Canadian market, and as such, the Canadian market does have a significant exposure to gold. The materials sector in Canada is currently
20%, and the gold sector, specifically your precious metals, is 13% of the Canadian stock market today.
It's better than having Google. So if you invest in Canada, you do have exposure to gold. So you don't need to see gold separately in your account to have some influence from it. But investing specifically in gold is something to be very careful about, and I don't care who you are. You can't tell me when things are going to go up and go down. I've heard every story and every conspiracy theory. None of it's reliable. It makes it very, very difficult to, if you're trading in and out of it and you make money at it, you've gotten lucky. All right, this is my third time giving this presentation, so I can jump into it. Well, hopefully it'll come back. Bitcoin is the next one. Now, I alluded at the start, most things have a place in the world. Bitcoin doesn't. Bitcoin is the world's largest Ponzi scheme, and I'm on record as saying it's going to go to zero, and there are Nobel Prize winning economists who agree with me. It is not supported by anything. It's got no system around it. Now, that's not to say that people aren't going to make money at it. People make money at Ponzi schemes. Absolutely. There are people who can make money at it. But it's also not stood up to be anything that it was supposed to be. One of the claims that for Bitcoin is it's a store of value. It's a competitor for gold. Josh and I, you showed me that podcast, wasn't it, where they were talking to, the podcaster was talking to the Winklevoss twins, and who are the big crypto guys. And this podcaster asked the Winklevoss twins, there we go, hey, about, why, Bitcoin was going to be so valuable. And I swear to God, this was the answer. They said that Elon Musk had found an asteroid that was 100% gold, and he was going to land it. And when that much gold came into the world, gold was going to become worthless, and all the money was going to flow to Bitcoin. We thought they were joking. The podcaster thought they were joking. No, that was their actual pitch on why Bitcoin was going to become valuable. Needless to say, Elon Musk has not landed an asteroid full of gold, and we're still waiting for that to happen. But anyway, let's take a look at some major Bitcoin events, because one of the things they hold on site, it's a way to protect yourself. It is a diversifier. It's safer than gold. It's safer than currency. It's outside the control of any government organization. It's going to protect you. Mt. Gox collapsed in 2013. Bitcoin dropped 50%. Now, I'm a geek. I'm a geek's geek. So I know what Mt. Gox stands for. The best way to understand Bitcoin is, has anybody ever played Pac-Man? Everybody knows what Pac-Man is, right? You know that little score in the corner that you run up like from eating all the little beads things? That little score, that number, that's kind of like a Bitcoin, because nerds can trade that to other nerds to buy things for their video games. That's kind of what a Bitcoin is. So Mt. Gox was a server, because this all is on computers, that's the only place that exists, was a server that originally was for an online trading card server. So people would go onto the server to trade their trading cards. It stands for Magic the Gathering Online Exchange. So the kids that were playing card games were using this computer to trade cards back and forth. That kind of died down. They repurposed it and made it a Bitcoin server, and obviously didn't put any security on it. And it caused a huge theft to happen, and then the Bitcoin dropped by 50%. I think it was all one day or a very short period of time. Black Thursday in 2020, it was a 39% drop in one day. China banned mining in 2021, 30% drop in one day. FTX insolvency, most of the major players in Bitcoin are either have gone to jail or have been convicted of things. That was in 2022, a 16% drop. Oh, this is the Ayatollah shock, 23%. Again, at a time when things got really, really uncertain, everybody said, this is what's going to protect you, and it did not. The average daily move for Bitcoin is 3 to 4% compared to the S&P 500, which is 0.7. The stock market you trade in has circuit breakers. If things go bad, they stop trading for 5 minutes. All right, so if things start to fall, there's a pause, everybody takes a breath, and then the market reopens, and if things continue to be volatile, there's circuit breakers built into the system to protect against massive moves. There are no such things in Bitcoin. So you're seeing average daily moves. So people call this a currency. So here's some of the moves that we've seen in Bitcoin. So it got up to $125 to USD. And at the time of this slide, it's 68. It's about 68 right now. It got down as low as 60. So it's about a 50% drop from peak to valley. That kind of volatility, don't tell me it's a store of wealth. Don't tell me it's a currency. These movements are so drastic as to make it not useful for either one of those things. The other context we give is Josh and I did a podcast, for those who don't know, Bare Naked Money. It's a great podcast. I'm going to reference it a few times. And we had a cybersecurity expert come on and talk to us about different cybersecurity threats that are out there. One of the things that people are familiar with are when they do a ransomware attack. So they freeze your system,
You pay me Bitcoin and I'll give you your AFL. And that all happens using Bitcoin, or the majority of it happens with Bitcoin. And it was fine. We're talking to him, and he was explaining how it all worked. And at the end of it, he goes, and as soon as the
Criminals receive the Bitcoin, they convert it to currency because they don't trust Bitcoin. Wait, the criminals don't trust it. Even the thieves that are stealing using Bitcoin as a way to steal move the money into currency as quickly as they can. Which again, if thieves don't trust it, again, it has its issues. So does anybody have any questions about Bitcoin? You can save it for the end, or you can ask. You can come up later and ask if you like. Real estate investing. We had Rob Carrick on our podcast about a month ago. And Rob Carrick, many people would recognize the name. He's one of the most famous Canadian finance commentators who's retired from the Globe and Mail. And he's had a lot to say over the years about a lot of things. And I was excited to have a conversation with him. One of my questions to Rob Carrick, I said, Rob, what's the most controversial thing you ever said? You were always a polarizing figure. You always had people angry with you. You were always going where people feared to go. What was the most controversial thing you said over your whole career? And without hesitation, he said, you don't have to own a house. And they go, really? It's like, it's okay to rent. And he went into it because his professional opinion as a financial commentator was that real estate's not a slam dunk investment. He wasn't against owning real estate, and I want to make sure that nobody thinks I'm against owning real estate. But the point is it's okay not to, because real estate as an investment has some issues. And we're going to go through some of it here, and we're going to use REITs as a proxy to talk about real estate. Individual communities, individual towns, individual pieces of real estate are all different. It's not like buying a stock that's the same across the country. This is a regional thing. So we're going to talk in generalities and tell a couple of stories about the concerns that you can have when investing in real estate. And it's not that you should invest no money ever in real estate. It just should not necessarily be the most dominant part of your investments. So 5 years, REITs at 4.7, the overall TSX is at 12. One of the things from a portfolio management perspective, if I'm investing in something that is not as liquid, I'm giving up access to my money, there's not an open market for it, I expect a premium. So when you buy real estate, you're losing a little bit of access to that money because real estate is not easily traded. So you expect a premium. So the last 5 years, and I will say the TSX has had a banger of the last 5 years for sure, because as Josh said, Canada doesn't suck right now. But at this point in time, the 5-year number, that's what it is. Over 10 years, again, there's still a significant difference. You go at 15 years. So over the last 15 years, real estate investment as an investment trust, again, not owning your own personal home, has not kept up with just the broad stock market. So you're involved in something that is less liquid, where you should be expected to receive a premium for, and it wasn't able to keep up with just a regular traded stock portfolio over that time period. There are big forces that move real estate. Interest rates are a big deal. You go through a boom and bust cycle. We've gone from having a huge housing shortage to having housing oversupply. Toronto's having their condo issues right now. It can be a very cyclical thing. And cyclical things, on top of not being as liquid, pose a real problem. And higher interest rates are, again, another one of those factors that dramatically affect the price of real estate. The stuff they say, diversification. We have to be careful because we think diversification is good, but we put the word thoughtful in front of it. Diversifying into something else just because it's different and that's the only reason you're in it, that's a trap, and it's used to sell a lot of garbage. Okay, so diversification that's not thoughtful, is not planned, is dangerous. They will build these up with monthly or quarterly income. Income is good, but the problem is the way some of these products are out there, we're going to talk more about it later, sometimes they're giving you your own money back. It's not necessarily money they're making. So they know that if I walked up to you and said, hey, listen, I can get you a 12% income stream off of your money, 12% return on my money, that's not what I said, but okay, that's what you heard. 12% of your money you get back every month. That's compelling because that seems to be a great rate of return, but it may not actually be 100% profit that you're receiving. You could be receiving some of your own money back. The products that they put together in REITs will give you liquidity. They absolutely will. You can buy and trade them on the market within regions. There's times when that's not as possible, but you can do it. So it does provide a level of liquidity in doing it this way. And professional management, the rest of that sentence is for a fee. Okay, so there's costs associated that aren't always apparent when you're investing in real estate in this way. Rate sensitivity, sector concentration, lower long-term returns versus equities currently. There have been periods of time when the mortgage rates went from 22% down to 0. If you track real estate prices over that time, that was a banger investment. It's difficult to imagine interest rates are going to go from where they are now and drop another 22% because, well, that would be a negative interest rate, and I don't think that that's practical. So it has had a run, which is part of what was whispered into everybody's crib when they were young. Real estate is always a good investment. You'll never lose money at it. But it has not held up as an investment class that you can use for 100% of your investments. It can play a part, but you got to be careful. It's not a slam dunk. I personally had a client who had a condo in Fort McMurray that he had to pay the mortgage on for 10 years before he was able to sell it for more than the mortgage. Those things happen. We've got examples of clients trapped in real estate, all different kinds of scenarios. Just be careful. It's not an answer. It's not the total answer to any kind of an investment portfolio. Covered call ETFs. Now, I was terrified of this one. This is Josh's favorite. Josh hates these. But I was terrified because it's a really difficult concept to explain to people. Then we found a way. So I'm going to make you a deal. Let's just say you're going to buy a house right now. You're going to buy a house, you're going to spend $500,000 to buy a house. I'm going to make you a deal right now. I'm going to give you $3,000 every year you own that house, just because I'm a good guy. But when you sell that house, if you sell it for more than $500,000, I get to keep it. So you're going to make a deal with me. I'm going to give you income for your house every year. And if you happen to sell it for more than you paid for it, I get that money.
The difference.
Yeah, the difference. If you sell it for more than $500,000, I get that money. Who wants to take the deal?
I have a question.
Sure.
Because when you ever buy real estate to live in yourself,
Yep.
you have to spend money on different upgrades.
Then that goes back to using it as an investment for sure. And that's one thing.
You have to pay upgrades and stuff like that. That means for any work that you
Yep.
do, you won't receive any benefits.
Yep,
for it.
no, absolutely. And that erodes the value of it as an investment. But I have an offer out here. I'm trying to get people to make a deal with me. Who wants my money? Who would take $4,000 a year? I'm going to pay you $4,000 a year. I'll pay you $5,000 a year. I'll pay you $5,000 a year on a $500,000 property. I just get if you sell it for more. I will keep going until somebody takes the deal. That essentially is what a covered call is. Okay? It's owning something that you give away or you sell the future growth of it for a little bit of income today. So let's see how we can screw that up. They're covered call ETFs. So there's a provider in Canada that launched AI investing. Who wants to invest in AI? Woo! All it was they went out and bought one stock, NVIDIA, which is a very big name, one of the biggest names in the AI sector, one of the highest growing. And they said, you know what, we're going to sell you shares in NVIDIA and we're going to pay you an income off of it. I get to invest in AI and I get income. I get to win. I'm going to make all kinds of money off of the AI side of it and I'm going to get paid while I'm in there. I'll take that. And it was actually pretty popular when it first launched. So this is growth of $10,000 for a 3-year period. This is the covered call. So you would have had $23,000, so you would have more than doubled your money over that same time period. If you had just bought the stock, you would have had $109,000. For that income you were getting, you gave away all that upside. You bought a growth investment because you wanted the income. They sold you on the income. And you gave away all the growth that you would have had just by owning the security if you wanted it. But wait, Colin, I've removed risk. It's less risky to do it this way. Oh, have you? No, you haven't. So, and these are all Josh's slides. I should let Josh do this, but I'm having too much fun. and he gets too wound up. So we went back to using index. So the product that's been launched recently doesn't have enough of a history, so we've gone to show some index. So this is the S&P 500 in 2008 was down 37%. A similar cover call strategy was still down 28%. It's like, yay, I win. I saved 9%. I don't feel good, but yay. So what if we do both sides? Let's see how much of the downside you save versus how much of the upside you give away. So the down market here is showing you saved 6% on the downside. On the upside, you gave away about 20. This is a financial product that is sold based on giving you an income, changing the risk profile of it, and making you think you're better off. The reality of it is that it doesn't effectively do what it holds itself out to do. And they charge a fee on the way. So if somebody comes to you, starts talking about, I'm going to give you income out of the product, this is one of the ways that they're going to structure it, by using covered call strategies. And it is very prevalent and very successful. There are providers on the street, that's 100% of the product lineup, because it's so easy to sell. If I was a salesman, I could sell this. But that's the outcome, and I'm going to be there, or a member of the team is going to be there to meet with you a year from now when it blows up, and I don't want that meeting. I think that's pretty good. I think that describes it well. I was really terrified about bringing that slide out, to be honest. All right, next one, Magnificent Seven. Oh, we have a question.
Is that a lot like a reverse mortgage?
Let me think for a second. A reverse mortgage has its place as a tool, I'll give it that. So if you come to me and you're 80 years old and you're running out of money and you want to stay in your house for a couple of years and you don't qualify for conventional lending, doing a reverse mortgage to buy yourself a few more years in your house by eroding some of the equity in it, that has its place. That's a fair trade-off. That's a product that, you know what, in some situations I could see makes sense. It's expensive. It's the least effective way of doing it. But if it's your only way to do it, I'll give that a spot. I don't give that a spot. I don't think that that's an effective way of doing shit. Oh, there we go. my first S-bomb. The Magnificent Seven. Anybody know what I mean by that? Oh, come on. Throw me a bone.
It is a movie.
This is Google, Amazon, Tesla, NVIDIA, all the biggest tech names, okay? So up until fairly recently, it was like, this is where you had to be to make money. And they've been fairly dominant, for sure. 5-year annualized performance, 30% holding that group of companies, compared to 13% of the overall market. And that time period is the 5-year annualized performance. 3 years worse, or better, depending on which side you're on. It's even more bigger. So they've become an absolute dominant force. People compare this back to the dot-com problem we had in 2000. There's a difference here. These companies are all actually profitable. They're just trading at valuations that are difficult to make sense of. And they become a dominant player. So many people who are talking about outperformance and having done well over this last period of time, almost by definition have had to hold a big weighting in this sector.
Can I tell my tow truck story?
You
Because I think
bet.
it fits perfectly with this slide. So this is 2 years ago now. I was in a car accident. Everything was fine, so don't worry about that. I like to start with that. But so I had to get picked up by a tow truck. So I got picked up by the tow truck driver. We started chit-chatting because we had a 30-minute drive to get to the car lot, basically. And he starts asking me what I do. I tell him, I'm a financial advisor. And he says, what do you invest in? And so I kind of give him a bit of a spiel. And I said, what do you invest in? Because he started saying, yeah, I do some of my own stuff. And he said, well, I got a bunch of cryptocurrency stuff. And then he rhymed off a bunch of cryptocurrencies that I didn't know. And he's like, yeah, I do some stocks too. I was like, which stocks? He's, Amazon, Tesla, Google, NVIDIA, Apple, Microsoft. See any comparison? This is my tow truck driver. I don't think he had a deep financial background, but I don't know. Maybe he did.
Yeah. Whenever that story gets told, all the professionals go, ooh, no, it's time for us to get out of the pool. But this is the kind of run-up, and this is where it was getting all the attention. So people are walking up to you at parties going, my portfolio is doing really well. I made 40% a year for the last couple of years because I invested in all the right things. Oh my God, that's great. I want that too. I should do that now. Maybe not. Downside example, in 2022, we had a market pullback. Those were down 46% compared to the overall market being down 18. Now I know that doesn't sound like it feels good. But the way math works, if I lose 50% of your money, I got to make 100% to break even. It's more important to protect the downside than catch the upside. And that's a very significant amount to be down compared to the overall market. That's the risk. Recent weeks, well, it was recent weeks when we did the slide. We probably should update this one. A 6.3% drop into this year compared to a flat on the market. So these stocks are just more fragile. They are more fragile so that when people get scared, they're going to get a disproportionate amount of attention and people are going to sell those first. Because the other thing that plays out, when people get really excited about things, they leverage into them. They borrow money to buy them. So when things start to drop, it hurts them even more. So they get even more volatile on that end of the market. So right now, these companies are trading at very what we call stretched valuations. So when things are difficult and people are afraid, those tend to be the companies that get hit first from a share price perspective. Full disclosure, we do have some exposure to this, but we have set out to be underexposed. We do not want a market exposure to this. We want to be less exposed to this than the market, because the market, last I saw, Josh, it was 30% of the S&P was those. It's about 30%, almost 1/3 of the market is made up by those 7 companies. I feel much safer when you're with me. I can check all these things. So,
Question?
oh, sorry.
Doesn't it depend on how long it's down for? If something drops, like, I mean, when I invest, I don't invest for 3 months. I invest for a long period of time.
Yep.
So if the market drops, it's going to go up later on anyhow. So don't you have to kind of see how long is it down for?
So the time horizon of your investment is absolutely taken into account when we put together a portfolio. Our job as portfolio managers is try to give you the best possible outcome. One of the ways we can do that is lean away from the very, very expensive things and position your money with things that show better value. Expectation is over time, that's going to give you a better experience with your investment portfolio over that long-term time horizon. Nortel went to zero, and I'm not saying these companies are going to zero, but you have very high-flying companies that run into very severe difficulties. So it's about getting you the best long-term rate of return without taking unnecessary risks. At this point, exposure to that sector, we would classify as unnecessary. I can accomplish your goals for you. I can get you the rate of return you need with minimizing the exposure to this. We don't have to be 100% in that sector. Okay, so in the entire history of the world, panicking about something has never made anything better. So you can panic, but you shouldn't. That doesn't help. You can get cocky. I just made money on gold, and I know those people. Most of them are in Nelson. But you shouldn't get cocky, because just because you were right recently doesn't make you all that smart. In investing, there are so many things you can do. Success usually comes from the things you don't do. That's the big finish. So, thank you. There'll be a test on the disclaimer at the end for all of you. But thanks for your attention. We're going to take some questions, but nobody is allowed to leave. The doors are now locked until everybody fills out a feedback form and tells us what they think and gives us ideas about what you'd like to see next. Thank you very much for your attention. Josh and I are here for your entertainment. Ask any questions you have.